Is permanent life insurance a scam? Have I been scammed is a very common question you get when it comes to life insurance policies. This is especially true with permanent life insurance policies. See, over the last 12 years, I've had numerous conversations with very smart people in their 30s, 40s, and 50s who've been paying hundreds, if not thousands of dollars per month for a life insurance policy that they don't quite understand. They're not even sure what it is and where it fits with their overall plan. It sounded really good when they bought it. They were told things such as tax-free money, borrow from yourself, become your own bank, create generational wealth, even guaranteed to not lose money, which can be easily mistaken with guaranteed to make money, but it's not. How can you resist that? I get a version of this conversation almost every other week. See, permanent life insurance policies are one of the most, if not the most controversial financial product out there. People have become millionaires selling this product. People have also preserved millions by owning this product. People have lost thousands of dollars by owning the product. They've also saved thousands of dollars by owning this product. On one end, it has one of the worst reputations in personal finance, and it's earned a chunk of that reputation, honestly. It's also one of the most misunderstood products in personal finance, and the truth about it lies somewhere in the middle. So let's settle this. Permanent life insurance, scam or not? The honest answer is no. Permanent life insurance is not a scam. It's a real product, real usage. The longer answer is that it gets sold to a lot of people it was never built for by people who get paid a lot of money to sell it. And that's where the bad reputation comes from. And by the way, there are multiple types of permanent life insurance policies, most commonly whole life insurances and universal life insurances with many sub-variations. I'm not going to pick apart the differences and similarities between them in great depth and detail today. I'm going to be talking about permanent life insurance policies across the board. By the end of this video, you'll know how these insurances actually work, what's under the hood, who it's really built for, and understand the specific situations where they make sense versus where they're completely the wrong choice. We'll keep this light, fun, and stay away from crazy technicalities, so if you are an insurance nerd, please don't get triggered. My name is Soho Fini. I cannot keep your houseplants alive, but I can teach you about money from experience. Let's dive into it. What permanent life insurance actually is. Let's start with the mechanics, because most of the confusion about permanent life insurances comes from people not knowing what it actually is. Permanent life insurances are insurance policies first and foremost. They are not investment accounts. The one exception is variable life insurances, where there is a legitimate actual investment component involved. We are not going to cover that today. They are not that common for good reasons. Now, back to permanent life insurances. The first component is the insurance itself. As long as you pay the agreed upon premium, there's death benefit that pays out to your beneficiaries whenever you die. Could be next year, could be in 50 years. The insurance company is on the hook either way. The second is the cash value. This is the living benefit of your policy. This is the portion of the policy that you personally have access to when you're alive. You see, a portion of your premium covers various costs associated with the policy, and another portion is invested in something. And what it gets invested in depends on the policy type. With whole life insurance policies, it is invested in a general fund or the general portfolio of the insurance company, which is usually more conservative assets. In the case of universal life insurances, it is usually a fund that you select and track the performance of a specific index fund. To be clear, it is not the same as actually investing in an index fund. It more so replicates those qualities within certain limits. In the case of a whole life policy, the growth rate is set by the insurance company in form of interest and dividends. In the case of an index universal life insurance, it's usually a rate driven by the underlying fund that you chose to track. In both cases, the growth is generally tax deferred, which means you don't pay taxes every year as the value of the policy goes up. But if you were to cancel your policy and effectively cash out, then you pay the taxes on your gains at a later point. Most people don't use a policy in that way to avoid the taxation. Over time, the cash value can accumulate and you as the policy owner can borrow against the cash value. That's the product. Now compare it to the alternative, which is term life insurance. Term life is just the insurance piece. You pay a premium, you get a death benefit for a set number of years, usually 10 years, 20 years, 30 years. If you die during that time, your beneficiaries get a payout. If you outlive the policy ends and you get nothing back. That's it. No cash value, no asset, just insurance. The price difference is massive. A healthy 35-year-old can buy a 20-year term policy for $1 million of coverage for somewhere between $30 to $50 a month. The same person buying the same amount of coverage as a permanent policy is looking at $800 to $1,200 a month, sometimes even more. That's a 20 to 30 times difference in cost. The permanent policy sales pitch is that the higher premium is buying you something extra. permanent coverage that never expires, plus cash value growing inside the policy, plus some tax advantages. The sales pitch is technically true. The question is whether it's worth what you're paying for, which depends entirely on who you are. Let's unfold that. Why it gets sold to people it wasn't built for. Here's where the scam reputation comes from. Permanent life insurances are very regularly sold to people who have no business buying them by people who have no business selling them. Yes, I chose violence today. These policies pay one of the highest commissions in financial services. The agent who sells you a policy typically earns 50 to 100% of the first year premium as their commission, plus smaller renewal commissions in later years. So on that $1,000 a month policy, the agent is making somewhere between $6,000 to $12,000 in first year alone. Compare that to selling you a term policy. Same person, same coverage, but the commission in a 20-year term policy at $40 a month is maybe $200 to $400 total. You don't need to be a conspiracy theorist to see what that does to the sales process. When the same agent can sell you product A and make $400 or sell you product B and make $10,000, guess which one gets pitched harder? The entire process becomes a mechanism to justify the sale. I know it because I've seen it firsthand. I've been in that position as an advisor at some point in my career. I have lived to tell the tale. This is why so many people end up with permanent life insurance policies they don't really need. They went to an advisor who turned to be an insurance agent. The conversation started with financial planning and ended with a permanent life policy of sorts. The pitch was wrapped in language about tax efficiency, infinite banking, be your own bank, guaranteed growth, asset protection. A lot of that language is technically accurate. The cash value does grow tax deferred. You can borrow against it. There are some genuine tax advantages. But for the average high earner with a W-2 income, 2 kids, a mortgage, almost none of those benefits matter as much as the sales pitch make them sound. The underlying issue is that permanent life policies is a small niche product being sold like a mass market product. The people it was actually designed for are a narrow slice of the financial world. The people that get sold to is anybody with income and a pulse. That's the scam adjacent part, not the product itself, the way it gets distributed. What it actually costs you when you buy the wrong policy. Here's the math most people don't see. Take that 35-year-old buying a permanent life insurance policy at $1,000 a month. In the first year, he's going to pay $12,000 in premiums. The cash value at the end of year one is usually somewhere between $0 to $1,500. Most of that first year premium went to agent's commission and the insurance company's cost. Year two, you pay another $12,000. Cash value at the end of that year is between $4,000 to $5,000. By year 5, total premiums are at $60,000, but the cash value is around $30,000 to $35,000. It typically takes somewhere between 10 to 15 years before the cash value catches up to the total premiums paid. That's the break-even point. That's the point that if you were to cash out the policy, you get back what you put into it. Now let's run the alternative. Same 35-year-old buys a 20-year term policy at $40 a month for the same million of coverage. Premiums at $480 a year instead of $12,000, the other $11,000 and some change. He invests regularly in a low-cost brokerage account. After 10 years at a reasonable long-term market return, that brokerage is worth somewhere between $160,000 to $180,000. After 20 years, it's somewhere between $500,000 to $600,000. He has full access to that money the entire time, not borrowed against, not collateralized, his. Meanwhile, the permanent policyholder has cash value he can borrow against, but borrowing against the cash value means paying interest on a loan against his own money. The death benefit is still in place, which has real value, but the term insurance buyer also has a death benefit through year 20, plus a much larger pile of accessible cash. For someone whose actual need is, I want my family covered if I die in the next 20 years while I'm building wealth, the buy term and invest the difference approach delivers more coverage during the window that matters and more money at the end. That is the math you don't see in the sales pitch. The pitch shows you a chart of the cash value growing inside the policy. It doesn't show you the chart of what your money would have done outside the policy. Hey, if you want my team to take a look at your situation, how you're set up, take the link below, go to our team. The consultation is complimentary. Let's get back into the video. When permanent insurances actually make sense. Now, I want to flip the script because I'm not anti-permanent life insurance policies. I own multiple and many of our clients do too. There's a version of this product that does real work for the right person, and you should know what that looks like so you can recognize it. Permanent life insurance is a tool. Like any tool, it's right for some jobs and wrong for others. Here are some of the situations where it actually makes sense. Number one, as an estate planning tool. The first is high net worth estate planning. If you have a net worth above the federal estate tax exemption, which is currently around $15 million per person, your estate is going to owe estate taxes when you die at a very hefty 40% on all assets above $15 million. that tax bill comes due quickly and it has to be paid in cash. Heirs sometimes have to sell assets, including businesses and real estate, at really poor prices to come up with that money. A permanent life insurance policy owned inside an irrevocable life insurance trust can be structured to pay out a death benefit specifically to cover that estate tax bill. The premium becomes the cost of buying liquidity at exactly the moment your estate needs it the most. For a family with a $50 million estate facing an $8 million estate tax bill, the math on this can work very well. Number 2, long-term liquidity. Remember the stuff we talked about in the beginning of the video about tax-deferred growth, access to cash, guaranteed to not lose money? Here's where those become relevant. In my book, the second place permanent, in particular whole life policies shine, is to provide long-term liquidity for high cash flow earners who have already maxed out everything else and want to diversify their conservative assets. If you're a business owner pulling significant income, you've already maxed your 401k, your defined benefit plan, your back to Roth, your HSA, and you've already have a healthy taxable brokerage account in place, then a whole life policy can be a place to park additional capital for tax-deferred growth and access in retirement. The key word here is already. This is not a replacement for those accounts. It's a stop you make after them. In your case, you're solving 2 problems. Number 1, access to liquidity that is not impacted by volatility, whether it be in the stock market, real estate market, or across the entire economy. Number 2, tax-deferred growth on a conservative asset. Compare this to interest and dividends that you earn in your brokerage account or high-yield savings account. They're subject to ongoing taxation. You're already paying a ton of taxes. You want to reduce them if you can without losing comparable yield. Number 3, need for permanent death benefit. The third place is a permanent coverage for a permanent need. Most life insurance needs are temporary. You need coverage during the years your kids are dependents, during the years you have a mortgage, during the time you're in your prime earning years. After that, the need usually goes away because you built enough assets to self-insure. But some needs are permanent. A child with a lifelong disability who will need financial support for the entirety of their life, that might warrant a need for a permanent death benefit. A family business that needs liquidity to stay together when the owner dies, regardless of when that might be, they might need a permanent life insurance policy. In those cases, a permanent product might make sense because the need is permanent. Those are the places where permanent policies pull their weight. I want to add a really important piece of information here. Not all permanent policies are the same. There are 2 factors that get kind of technical, but you cannot afford to ignore them. Number 1, the insurance company you buy the policy from. And number 2, the policy design itself. Let's talk about the company. There are hundreds of life insurance companies that will happily sell you permanent life insurances. I personally can count the ones worth considering on one hand. We won't name them here today. The reason the company matters is that life insurance companies vary in size, cost, balance sheet, product mix, and overall financial health. And if you plan on parking money with them for the rest of your life, boy, that requires some serious due diligence. You really need to pop the hood and look at the company's history, financial facts, beyond the ratings they tell you about. Number 2 is the policy design. This is where you need to work with fiduciaries who are very experienced on this topic and focus on the optimal policy design instead of optimal commission compensation. That's right, there are ways to make the policy more optimal in its cash value growth and access to cash. However, they almost always mean smaller commissions to the agents or advisors who write the policy. Imagine you buy a life insurance policy and pay $100,000 per year in premium. With a conventional policy design, your agent could make $50,000 to $100,000 in commission in the first year. Same policy, but an optimal design for the policy owner would pay a fraction of that. I believe in saying the quiet part out loud, pointing out the facts. There is nothing wrong with an expert getting compensated for helping you acquire the right solution. The problem is when all of that is thrown out the window because the agent is already spending the commission check in their mind before they show you the illustration. The honest test. Here's how to figure out where you actually fall. Ask yourself a few questions. Number 1, have you maxed out every other tax advantage account, such as a 401k, HSA, back to Roth, and have you already built a healthy amount of money in your taxable brokerage account? Number 2, is your net worth in a range where federal estate tax is a real concern? If you're under the exemption with no expectation of crossing it, the estate tax argument doesn't apply to you. Number 3, do you have a permanent need for life insurance, meaning a need that doesn't go away when your kids grow up and when your mortgage gets paid? If your need is temporary, term insurance covers it for a fraction of the cost. Number 4, are you working with someone who is genuinely showing you both options side by side with the math on the alternatives clearly laid out? If you cannot answer yes to most of those questions, you probably don't need a permanent life insurance policy. If you answered yes, then the next step is to have a conversation with someone whose entire business model and economic incentive is not dependent on selling you a policy. go talk to a fee-only advisor or a fee-based certified financial planner. Ultimately, this is not a video to dismiss or glorify permanent life insurances. The honest answer to the question, is permanent life insurance a scam, is this: the product isn't a scam. The ideas are conceptually sound. However, the problem is how it's positioned and how it's sold. The math works for a small group of people and gets pitched to a much larger group who don't need it, and in many cases sold by people who don't even understand it. Your job is to figure out which group you're in. If this brings up questions for you, click the link below this video and book a complimentary consultation with our team. If you found this to be helpful, like, comment, and subscribe. I'll see you in the next one.